I have tested multiple fast account growth strategies that actually grew the account fast. Some of these growth methods turned $20 into $50,000 really fast within a few months. But then some took a long time to do the same thing. But then the strategy that grew the account fast also had higher risk. So one might wonder which strategy is the best that keeps the risk low and grows the account really, really fast. So I decided to rank these fast growth methods to see which one is the best. The fast growth methods I am going to put near the top of this list are good, and the strategies I am going to put near the bottom of this list are bad. I'm also going to share some of the fast growth methods I have used in my own trading journey, and the best one I use right now. First, let's start with the 1% rule. This growth method is popular among day traders because it turns $1,000 into $180,000 in just 2 years. This can sound unrealistic, but the funny thing is, in my around 8 years of trading journey, I have seen around 3 people actually do it. 2 of them were scalpers, meaning they tried to capture small price moves with bigger position sizes and took a lot of trades in a day. The other one was not a scalper, but he did trade on extremely small time frames and exited trades pretty quickly. All 3 traders turned around $1,000 to $10,000 into $200,000 to $1 million in just a few years. All this 1% rule says is to aim for 1% daily profit. If you have successfully made a 1% profit in a day, then you stop trading for that day. The next day, since your account size will be bigger because of the previous day's profit, you will now calculate everything, like risk and position size, based on this newer and bigger account size. If you lose money at the end of the day, then you keep using your previous bigger account size to calculate everything. You can take however many trades you like. The only thing that matters is reaching the 1% daily goal. If you continue to achieve your daily goal for the most part, then with the power of daily compounding, your $1,000 account will turn into around $180,000 in just 2 years. But then, the only thing wrong with this method is that it assumes everyone can find good quality trades every day. I certainly can't. The scalpers I saw make fast money with this method were taking hundreds of trades in a day. A normal day trader can find it very difficult to take good quality trades every single day. If you can't take trades in the first place, then you can't reach your 1% goal. So I'm going to put this 1% rule growth strategy below the best tier. The main problem is that not every trader can find quality trades every day. The next growth method is the stage-based method. I used to use this method until I found a better one. Basically, in this stage-based method, if you have a $10,000 account and you risk 1% of that on each trade, which is $100, then you keep risking the same $100 until your account grows by around 30%, which in this case is $13,000. From the next trade on, you risk 1% of this 30% bigger account size. When the account size grows by another 30%, then you increase your risk again to match that bigger account size. Basically, as your account size grows in stages, you increase your risk in stages. I have used this stage-based method since I was trading on really small accounts around 8 years ago. I only compounded and added money into the trading account after I had made around 30% profit on the previous amount. This made sure I was depositing more capital into trading only after I had made some progress. But this stage-based method is a slow way to grow the account compared to the better method I found later. I will show you in a moment. So I will put the stage-based method in the C tier. The next is the $20 to $52,000 growth method. This is a level-based system to grow a really small account into something really big, really quickly. You start with just $20 on level 1. Each level has different account size requirements. As your account grows, you progress to higher levels. And at the end of the 30th level, the account size grows by around $52,000. This is more of a challenge. If you want to learn more about it, check out the detailed video I have made on the Trading Rush channel. When I tested it using 1,000 trading bots in one of the previous videos, 99.5% of them successfully completed this challenge and turned $20 into more than $50,000. But then the data also said that to complete this challenge, the win rate has to be high, constantly throughout this challenge. That's because the risk per trade in this challenge is really high, like around 23%. When I tested this challenge with a medium to low win rate, then only 30% of the trading bots successfully made $52,000. That high risk doesn't work with medium to low win rate strategies. The thing is, even if you have a high win rate trading strategy, it can get a lower win rate in a bad market. And we don't know when the market is going to get bad. So if you start this $20 to $52,000 challenge and the market gets bad, then it will be very difficult to complete the challenge. In other words, this fast growth method requires us to get lucky with the market conditions as well. But then, since this whole fast account growth challenge starts with $20, the risk in dollar amount, even if we don't complete the challenge, is really low. So I'm going to put it in the B tier. If the starting account size was high, then I would have ranked it much lower because of the higher risk. The next strategy is one of the forbidden strategies. When I tested it with a trading bot in one of the previous videos, it turned $10,000 into around $60,000 really quickly. But when I tested it with more trading bots, every single one of them made money initially, but then blew up the account at some point. Basically, this strategy makes a lot of money really quickly in the short term. But then, if you continue to use this strategy in the long term, there is almost a 100% chance of blowing up the account. The strategy I am talking about is none other than the martingale trading system. The martingale strategy says to double the risk every time you lose a trade. If you risked 1% of the account and lost, then it says to risk 2% on the next trade. If you lose that too, risk 4% next. If you lose again, double the risk to 8% and so on. If you win a trade, then the risk goes back to 1%. Don't use the martingale trading method even if it makes a lot of money in the short term. I'm going to put it in the D tier. The next method of growing fast is using high leverage, taking positions that are bigger than your account size. The thing is, high leverage in the wrong hands is really bad and can blow up the account really quickly. But high leverage in the hands of an experienced trader who has a proven data-backed profitable trading strategy can grow the account quickly. I have been using leverage in most of my trading journey, and it always felt like a normal part of trading. But remember that I'm not talking about risking a large portion of your account on a single trade. I'm talking about using high leverage to take trades that you otherwise couldn't because the account size is too small or something. Whenever I used high leverage, my risk at stop loss was almost always low, like around 1% of the account. So I'm going to put it in the A tier. The next method is used by traders to increase their win rate. Basically, you know how in the stock market when the good stock goes down, people buy? And if it keeps going down, people keep buying more? They basically average down because the price has a higher probability of going up in the long term. Even if your first entry was wrong, the second entry at a lower price moves the average entry price down. That gives you a better overall entry point, which results in a better overall profit when the price finally moves in the upward direction. Many traders have applied this averaging method in trading as well, but doing too much averaging, or in other words, taking too many trades in the same direction, is really bad in trading. Unlike the stock market, the price in trading can move in the opposite direction for a long while. If you average too much, then you will definitely blow up your account or lose a big amount at some point. But when the markets are bad and there is no one clear entry point, splitting your trades into multiple entry points can result in a better win rate overall. If you are only averaging once or twice with a smaller risk at stop loss, the overall risk remains pretty low. In some strategies, like the grid trading strategy we saw in one of the previous videos, averaging plays an important role. In that video, we saw a trader make a 200% profit in a month and a 1000% profit in just a few years. That high profit would not have been possible without averaging in the grid trading strategy. I also applied the averaging method in one of the testing videos, and it got around an 87% win rate. Still, averaging in the wrong hands can result in bigger losses. So, overall, I'm going to put it in the B tier. The next growth method is the best growth method I have found yet. This is what I use right now. This method was taught to a group of strangers by the multimillionaire trader Richard Dennis in the 1980s, who had turned around $5,000 into more than $100 million. I have made a detailed video on this topic. The rule is really simple. Every time your account increases or decreases, you use the current account balance to calculate your risk and position size. If the account grows from $1,000 to $1,100, you use this $1,100 to calculate everything while taking the next trade. If the account goes from $1,000 to $900, you use these $900 while calculating everything on the next trade. When I tested this position size growth method in one of the previous videos, the account not only grew really fast, but the probability of blowing up the entire account also decreased. This is the only method that not only grows the account fast, but also reduces your risk. That's why I use this one right now. Now you know which one is the best and which one you should ignore. Thanks for watching.